Part 3. The National Credit Act, Historical Background and Purpose, Core Provisions and How They Work in Practice, Interest Fee Caps, Debt Review Machinery, Enforcement and Court Corrections, Where the Act Fails Households, Systemic Consequences, Reform Direction Consistent with Sovereignty. 1. Historical Background and Stated Purpose. Parliament enacted the National Credit Act 34 of 2005 to promote a fair and non-discriminatory marketplace for access to consumer credit, prohibit reckless lending, and create a single system for credit regulation and the National Consumer Tribunal. The act was assented to in March 2006 and came into operation in phases from 2006-2007. Justice Government of South Africa. Subsequent instruments tightened mechanics. National Credit Amendment Act 19 of 2014, commenced 13 March 2015. Government of South Africa. Affordability assessment regulations prescribe how credit providers must assess income, expenses, and discretionary income. An initial suspension to fix implementation was gazetted in Aug 2015, then the rules took effect thereafter. Law Library, +1 Credit, ombud.org.za. Review of limitations on fees and interest rates, reset maximum initiation service fees, and pegged maximum interest by product to the repo rate plus margins. Government of South Africa. Credit life insurance regulations capped compulsory credit life premiums and set disclosure standards. Law Library, Moonstone. Bottom line of purpose. A single statute to curb abusive lending, standardize costs, and give over-indebted consumers lawful relief on paper. Justice 2. Core Provisions. What the NCA actually requires, reckless credit and affordability duties. A credit agreement is reckless if the provider fails to conduct proper affordability assessments or if the consumer could not afford the debt at inception. Courts judge recklessness as at the time of granting. SAFLI Debt Review. Over-indebted consumers may apply for debt review, leading to a court tribunal-sanctioned rearrangement of obligations. Detailed procedural rules are set in the regulations and NCR guidelines. pbsa.co.za, Pre-Enforcement Notice and Enforcement. Before legal action, a credit provider must deliver a Section 129 default notice offering remedies. Courts have repeatedly policed delivery requirements. The NCA was amended in 2014 to clarify modalities. SAFLI, Cost of Credit Limits, Interest, Initiation, Service Fees. The 2015 regulations fix caps by product. Service fees are capped at R60 a month. Initiation fees are tiered by agreement type and amount. Government of South Africa, Statutory in duplum. Once a consumer defaults, the sum of interest and certain charges that accrue thereafter may not exceed the unpaid principal at the time of default, codifying and strengthening the common law in duplum rule. KPMG, Assets University of Pretoria, 3. Caps and charges in the real world. Interest cap structure. The 2015 amendment pegs maximum nominal annual rates to RR. Examples from Table A. Mortgage, RR plus 12% PA. Credit facilities, RR plus 14% PA. Unsecured credit, RR plus 21% PA. A. Developmental credit, RR plus 27% PA. Short term, 5% per month, 3% per month. Incidental credit, 2% per month. Government of South Africa fees. Service fee max R60 month. Initiation fees vary. Initiation may be charged only on new agreements, not transactionally. Government of South Africa Credit Life Insurance. Since 10 Aug 2017, premiums are capped with mandated disclosures. NCT has sanctioned providers who exceeded caps. Law Library, masthead.org.za. Compounding. The NCA does not ban compounding interest before default. It limits the total post-default accrual via Section 103. In practice, interest is often calculated daily and capitalized monthly within the caps, then in duplum caps the pile after default. Courts and academic analysis confirm the statutory in duplum scope and timing. SSRN Centaur. Implication for households. Even with caps, high RR-linked margins, layered fees, compulsory insurance, and permitted compounding before default keep the effective cost of credit steep, especially on unsecured and short-term loans. The law sets ceilings. It does not force fair pricing. Government of South Africa 4. Debt review machinery. Promise versus lived reality. The NCA's debt review was meant to be a lifeline. The regulations prescribe affordability norms and debt rearrangement procedures. NCR guidelines and declaratory orders detail filings. Law Library, dcasa.co. But on the ground, consent and abuse? The NCR's 2023-24 report highlights debt review without consent and misuse of electronic signatures. Matters were referred to the NCT and registrations canceled. Trade and Industry Department backlogs and outcomes. In 2023-24, the NCR received 1,950 complaints, with 48% resolved. It secured R$2.4 million in refunds balance adjustments and $100,000 in admin fines via complaints, while separate investigations and enforcement actions yielded 14 NCT judgments, refunds, and fines against non-compliant providers. 47,757 clearance certificates were issued for rehabilitated consumers that year. Trade and Industry Department exiting review. Jurisprudence and commentary underscore complexities around termination, withdrawal, and the heavy practical impact of the debt review flag. SAFLI Plus 1, Section 129 protection. Courts insist on proper delivery of S-129 notices before litigation. The 2014 amendments codified delivery modes, and scholarly analysis continues to police compliance. This check exists because abusive collections were common. SAFLI EAOs fixed by the courts, not the Act. In 2016, the Constitutional Court held that emolument attachment orders required judicial oversight, inter alia, striking at abusive wage attachments used by lenders. This correction came via litigation, revealing gaps in protection under the credit collections ecosystem. SAFLI 5. Predatory microlending and short-term credit. The regulations explicitly allow short-term credit pricing at 5% per month and 3% per month thereafter within a year. Even with caps, that pricing, stacked with initiation service fees, extracts heavily from low-income borrowers. The NCR's 2023-24 enforcement work documents, raids against lenders retaining ID documents and bank cards, an illegal but persistent tactic to lock in repayment. Government of South Africa, Trade and Industry Department, credit life abuse curtailed only in 2017. Before the 2017 cap, premiums were frequently excessive relative to risk. The cap arrived late and still requires active enforcement to bite. Faizombud.co.za, Law Library. Systemic outcomes under the NCA. Unsecured boom and failure costs. South Africa saw a sharp unsecured credit boom culminating in African banks' failure and curatorship. The SARB stepped in with a resolution plan. This was not a rogue event. It exposed how mass-market high-cost credit can scale under the legislation's broad permission set, leaving households and the financial system exposed when impairments spike. Bank for International Settlements, South African Reserve Bank. 7. Where the NCA fails households. 1. Affordability in form, not substance. Regulation 23A is detailed, but providers pass checks with norms and bureaucratic proof, not genuine capacity tests. Case law and practice notes keep warning that failures can constitute reckless credit, yet enforcement resources are finite. cliffdecker-hofmirabsa.co.za. 2. High lawful cost of credit. RR-linked margins plus initiation and service fees make the legal maximum already punishing, particularly in a high-rate environment. Caps did not remove the extraction channel. They simply set the ceiling. Government of South Africa, Law Library. 3. Compounding before default. Because Section 103 caps post-default accrual only, compounding prior to default and fees within cap schedules still allow balances to swell before the consumer reaches the legal protection threshold. SSRN 4. Collections abuses needed constitutional correction. The EAO ruling shows that absent court-imposed oversight, wage stripping would have continued. The NCA did not itself prevent that practice. The court did. Safley 5. Debt review can trap or be weaponized. The NCR now flags debt review without consent and non-distribution problems. Consumers face long lock-ins and flags even as unscrupulous actors exploit the process. Trade and Industry Department 6. Credit information blacklisting inertia. While paid-up judgments removal was gazetted, adverse information mechanics still stigmatize households with slow redress. Government of South Africa, debtfreebidgie.co.za. 7. Regulatory capacity and capture risk. The NCR's own annual report notes budget constraints and staff losses impacting enforcement. As long as enforcement is under-resourced and industry expertise flows in and out of public bodies, revolving door risks persist. Trade and Industry Department, net effect. The NCA's intent is consumer protection. The real outcome is a legalized high-cost credit market where households remain the shock absorber, consistent with a system that outsources money creation via private credit and then polices conduct at the margins. Direction for Parliament, consistent with sovereign currency issuance. This portfolio rejects any defense of private extraction.
The steps below are law-grounded and South Africa-specific. 8.1. Replace the NCA's pricing spine with people-first ceilings. Short-term credit, replace 5%, 3% per month with a single-digit annual cap for any loan under a low threshold. Ban initiation fees on these loans. Government of South Africa. Unsecured credit, collapse the RR plus 21% formula to RR plus a modest single-digit. Prohibit capitalizing fees into principal. Bar interest on initiation fees. Safley credit. Keep the 2017 caps, but default to opt out with plain language disclosure and automatic premium reduction as balances amortize. Impose strict fines for overcharging. Law Library. lawlibrary.thanked.org.za. 8.2. End compounding on household credit. Legislate simple interest only on all household credit agreements, with monthly interest-only accrual and no capitalization of unpaid interest fees. Keep S103 as a backstop. SSRN. 8.3. Make debt review protective, not predatory. Criminalize debt review without consent with automatic reversal and compensation. Force fee refunds. Bar the debt counselor perpetrator from registration for a fixed term. NCR data shows the practice is real and harmful. Trade and Industry Department. Standardize exit. Automatic flag removal on certified completion or when indebtedness falls below a legislated ratio. Mandatory NCT fast track for consent restructurings at fixed fees. Trade and Industry Department. 8.4. Close collections abuses permanently. Write the Stellenbosch Legal Aid Clinic principles on EAOs into statute. Judicial oversight, proportionality caps, and jurisdiction safeguards. No enforcement by clerk's rubber stamp ever again.
Safley 8.5. Overhaul enforcement capacity and conflicts. Fund the NCR properly to run proactive investigations. The 2023-24 report shows what can be achieved even under constraints. Trade and Industry Department. Impose cool-off periods and conflict rules across the credit chain to break the revolving door risk that blunts enforcement. 8.6. Data sovereignty for supervision. Implement S69 fully with a state-backed credit registry to monitor the market in real time, not by industry self-report. Trade and Industry Department. 8.7. Community banking for productive credit. Parallel to NCR reform, capitalize cooperative community banks so working households and small firms access developmental credit at simple interest terms, shifting creation of purchasing power away from predatory channels. 9. South African conclusion. The NCR was a necessary consolidation, but, as implemented, it legitimized high-cost credit and left households exposed through lawful interest fee stacks, compounding, insurance add-ons, and procedural traps in debt review and collections. Courts, later gazettes, and NCR enforcement keep patching holes, but the architecture still privileges private extraction over public welfare. Parliament can and should replace this spine. Ban compounding, reprice caps to protect people, criminalize abusive debt review practices, codify EAO safeguards, fund the NCR to bite, and build community banking alternatives. That is how a sovereign currency issuer ensures that credit serves the nation, not the other way around. Key official sources: National Credit Act 34 of 2005. Justice Government of South Africa. Affordability Assessment Regulations and Subsequent Guidance Suspension Notice. Law Library +1 creditombud.org.za. Review of Limitations on Fees and Interest, Table A, Initiation Service Fees. Government of South Africa. Credit Life Insurance Regulations, Caps and Disclosures. Commencement 10 Aug 2017. Law Library, masthead.co.za. Statutory, in duplum, Analysis and Scope. KPMG, Assets, Section 129 Notices, Scholarly Treatment and Amendments. Safley, Stellenbach Legal Aid Clinic, Judicial Oversight for EAOs. Safley, NCR Annual Report 2023-24. Enforcement Stats, Complaints, Raids, Registry Plans. Trade and Industry Department, African Bank Curatorship and SARB Releases. Systemic Risk from Unsecured Boom. Bank for International Settlements, South African Reserve Bank. Part 4. Case Studies and Comparative Insights. Purpose: extract practical lessons that strengthen South Africa's sovereignty over taxation, money, and credit, keeping our focus at home while drawing on examples only where they sharpen our case. 4. Taxation Lessons. 1. Botswana's diamond regime. What a nearby resource state gets right. 2 points matter for Parliament. 1. Aggressive value capture on a strategic commodity. Botswana's framework chases a very high effective tax rate on diamonds through royalties, corporate income tax, and profit-based devices layered on a joint venture structure. Independent reviews and official analyses describe the model's goal as revenue maximization for the state. That is the policy intent, not an accident. 2. A formal profit-based mining tax formula with a floor. For non-diamond mining, Botswana's Income Tax Act employs a sliding 70 profit-based formula, showing how a rules-based design can claw back rents at high profitability while protecting the base at a floor, an approach South Africa can mirror for sectors where windfall rents arise. Behind the fiscal math sits ownership leverage. Botswana holds 50% in Debswana and has expanded its sales share in recent agreements, evidence of a state that bargains as principal, not supplicant. South Africa's minerals are different. The lesson is the posture, designed for value capture up front, not via after-the-fact pleas. Science Direct, Reuters, implication for SA. We should move extraction-focused taxation off households and onto sectors where economic rent arises, using clear profit-based formulas and ring-fence developmental uses, while we cut compounded taxes on the people. 2. Monetary lessons. South Africa already has the legal plumbing to reroute money and credit in the public interest without fantasy. 3 practical pillars. 2.1. Postbank as a people-facing state conduit. Parliament has already acted. The South African Postbank Limited Amendment Act 2023 moves Postbank into an appropriate bank-controlling company structure under the Banks Act and transfers shareholding from the post office to government, precisely to allow a public bank to operate more squarely in the regulated system. This is not a press release. It is statute. The purpose is to position Postbank as a state-owned retail platform that can transact at scale within prudential rules.
Government of South Africa.dcd.gov. What this means for Parliament. Postbank can be mandated to prioritise inexpensive transactional services, savings and targeted credit programmes, e.g. student support, smallholder agriculture, township enterprise, while coordinating with Treasury and SARB on liquidity and risk, reducing household reliance on high-cost private channels. 2.2. Cooperative community banks as a lawful second pillar. South Africa's Cooperative Banks Act 2017 explicitly exists to enhance access to banking services and to build sustainable, member-owned banks under proper supervision. That is a standing legal mandate to grow community-rooted credit, deposits and loans where members' interests, not shareholder returns, set the tone. Government of South Africa, plus South African Reserve Bank. Why this matters? South Africa already has massive, proven community finance muscles in stokvels, organised savings groups involving millions of participants. Sector bodies report more than 125,000 groups with 2.5 million individuals involved, underscoring the latent base for regulated, member-owned deposit takers and regional co-ops that can on-lend locally to productive uses. Parliament can direct the CBDA's capital and technical support accordingly. nasa.co.za. 2.3. A supportive external example. Bank of North Dakota. The Bank of North Dakota is a 100-year-old state-owned bank that partners with local community banks and credit unions rather than displacing them.
It purchases participations, provides liquidity, and shares risk for developmental lending, agriculture, small business, students, while returning profits to the state. The lesson is architectural. A public bank can amplify community banks and lower borrowing costs without running a credit free-for-all. Implication for SA? Use Postbank as a retail spine. Expand cooperative banks for local intermediation. And, if Parliament chooses, add a developmental wholesale arm that co-lends through community banks, with strict simple interest rules for household credit. 3. Credit and Debt Lessons 3.1. Usury prohibitions are not exotic. They are mainstream outside of our current orthodoxy. Across Islamic finance, the prohibition of riba is a core legal principle. Modern frameworks design profit and loss sharing or asset-backed structures to finance the real economy while avoiding interest as rent on money itself. Leading international analyses set out the logic and instruments available. The point for South Africa is not to import doctrine, but to recognize viable, interest-free design that aligns with our own historical rejection of usury. IMF Investopedia. 3.2. Jubilee-style debt release has textual pedigree. The Jubilee provisions mandated periodic debt release and return of land, preventing perpetual bondage and dispossession among kin. In South Africa, where intergenerational wealth has been structurally attacked, the principle is directly relevant. Consumer and smallholder debts should not spiral into permanent servitude. IMF Investopedia. 3.2. Jubilee-style debt release has textual pedigree. The Jubilee provisions mandated periodic debt release and return of land, preventing perpetual bondage and dispossession among kin. In South Africa, where intergenerational wealth has been structurally attacked, the principle is directly relevant. Consumer and smallholder debts should not spiral into permanent servitude.
Bible Gateway, USCCB, implication for SA legislation. Use this pedigree to justify simple interest only on household credit, hard induplum caps, and statutory write-downs at defined horizons for microcredit and unsecured debt, embedding mercy and social renewal in positive law. 3.3. Microlending at lawful high rates is still predatory at scale. Our own NCA regulations allow short-term rates of 5% per month on first loans and 3% per month thereafter within a year, plus initiation and service fees. That is punitive for poor households, with compounding before default. The lesson from our enforcement record is that policing abuses after the fact is never enough. The price spine must change. 4. Putting lessons to work, a South African implementation map. The following are South African actions, all inside our legal system or achievable via ordinary statute. A. Resource rent first, households last. Legislate a profit-based formula for sectors with economic rent, with clear floors and automatic windfall tiers. Earmark proceeds to public investment and balance sheet repair, not to general consumption. In parallel, abolish estate duty and zero-rate true essentials, cutting double, triple taxation on households. B. Use the state balance sheet before touching VAT fuel. Statutorily require Treasury to table a financing hierarchy and a household impact annexure for any proposal to raise VAT fuel levies. The aim is to prove that household taxes are not the first resort. Government of South Africa. C.
Build the public community banking duplex Postbank, operational mandate via shareholder compact, basic banking at low cost, targeted development credit windows, and payments resilience for grants and public services. Government of South Africa, cooperative banks,
Capitalize and expand via the CBDA. Simplify licensing for compliant member banks and allow wholesale deposits from state programs to be on-lent locally. Government of South Africa, South African Reserve Bank wholesale partner. Create a narrow, development-only wholesale arm that participates with co-ops, not competing with them, thereby multiplying capacity without recreating a monolith. D. Reprice household credit. Outlaw compounding. Replace NCA short-term and unsecured rate caps with people-first ceilings. Ban capitalization of interest fees. Keep induplum as a backstop. E. Embed mercy and justice in statute. Codify Jubilee-style write-downs for qualifying unsecured debts at fixed horizons. Align with simple interest regime and household affordability. Bible Gateway. F. Supervision that serves sovereignty. Fund NCR and CBDA on a multi-year basis to police conduct and build co-ops. Publish revolving door rules across Treasury, SARB, NCR, FCA pipelines to guard against capture. 5. South African conclusion for Part 4. These case studies and comparisons are not imports. They are tools to accomplish a South African mandate. Resource rent capture proves that design and posture can keep value with the nation rather than external creditors.
Public community banking shows we already have the legal chassis to move money and credit back to the people, supported, architecturally, by examples like Bank of North Dakota, Government of South Africa. Usury controls and Jubilee-style mercy have credible legal ethical pedigrees and practical instruments. They justify simple interest, hard caps, and statutory write-downs that end death as a life sentence. IMB folded into parts 1-3, these lessons deliver a single message to Parliament. Stop making households the balancing item. Capture rents where they arise, use the public balance sheet properly, rebuild community credit, and legislate mercy where finance prays. That is sovereignty in practice, rooted in South African law, serving South African people. Part 5. Recommendations to Parliament. People First Tax Reform. Monetary sovereignty in practice. Credit and debt reform that ends predation. Implementation roadmap. Oversight, metrics, and safeguards. Purpose and guiding principles. These recommendations turn the findings of Parts 1-4 into an executable program. They are built on 5 non-negotiables. 1. South Africa is the sovereign issuer of the rand. Budget approvals authorize spending. Tax is primarily a tool to manage inflation, anchor demand for the rand, and shape behavior, not a prerequisite for spending. 2. Households must stop being the balancing item. We end double, triple taxation of ordinary people and shift collection to true economic rents and monopoly profits. 3. Monetary and fiscal coordination must be explicit, lawful, and people-centered. We do not temper with institutional independence. We require transparent protocols and a publishing discipline that prevents regressive defaults. 4. Credit must serve the nation, not harvest the people. Replace the price spine and compounding practices that legalize extraction. Build public community banking channels for productive credit. 5. Everything proposed is achievable within the Constitution and ordinary statute, with clear roles for Parliament, National Treasury, SARB, SARS, NCR, and municipalities. 1. Taxation reform. A. End compounded taxation on the same income. Abolish estate duty and the CGT deemed disposal at death for primary residences and family business assets up to a high threshold. Families already paid PAYE, VAT, fuel levies, rates and fees over a lifetime. The final transfer must not be taxed again. Zero rate a true essentials basket. By schedule update, staple foods, infant elder care items, hygiene basics, school supplies, domestic energy for cooking, heating, up to a lifeline block. Publish the exact list alongside a household impact annexure. Reduce the fuel tax wedge on commuters and logistics by cutting the general fuel levy on petrol diesel by a fixed number of cents litre, swapping a portion of REF financing to on-budget funding with explicit annual votes, and prohibiting new tolling concessions on existing corridors without a local affordability test approved by Parliament. B. Shift the collection base off households and onto rents. Resource rent taxation formula for sectors earning above normal returns. Place the formula in primary legislation. Publish effective tax rates annually by sector. Anti-avoidance and illicit flows enforcement. Expand SARS's large business center staffing. Mandatory country-by-country reporting for MNEs operating in SA. Presumptive profit rules in high-risk channels. Targeted exchange control and transfer pricing audits tied to sectors with persistent current account leakages. C. Make municipal charges lawful, fair, and performance-linked. Require performance-indexed tariff adjustments. Where regulated service levels are not met, an automatic credit is applied to bills. For residential valuations, mandate independent objection panels and a cost-free first appeal per property cycle. Publish town-by-town median bill movements each year. D. Put tax back in its proper place. In the annual budget review, Treasury must publish a tax inflation alignment note that explains how the proposed tax mix assists inflation control and protects households, and why other financing tools were not used first. This re-anchors tax as macro stabilization, not as a pretext for extraction. 2. Monetary reform. A. Formal fiscal monetary coordination protocol, without impinging on independence, require a joint published protocol between the minister and SARB that aligns the inflation target with the medium-term expenditure framework, sets out how large relative price shocks are treated to avoid automatic shifts to VAT fuel hikes, confirms liquidity operations and debt management choices that support stability without crushing household demand. B. Use balance sheet tools before touching households. C. Codify a hierarchy of financing in the budget framework. Lawful balance sheet resources, issuance mix, then only as a last resort broad-based consumption tax increases. The minister must certify adherence to this hierarchy when tabling tax bills. D. Clarify the SARB ownership debate. Focus on mandate. If desired, legislate a non-disruptive redemption of private shares over time. But the key reform is mandate transparency, independence retained, people-centered price stability affirmed, and formalized reporting on distributional impacts of tightening cycles. D. Household impact annexure. For any proposal to alter VAT, fuel levies, or other mass taxes, Treasury must table a decile-by-decile RAND impact analysis, plus 2 non-household alternatives costed side by side. E. Pay, procure, and clear in RAND. Consistently, strengthen instructions to departments and SOEs to invoice, pay, and procure in RAND where lawfully possible, reducing imported indexation of contracts that unnecessarily transmits FX volatility into public prices. 3. Credit and debt reform. A. Replace the National Credit Act price spine. Simple interest only for all household credit. No capitalization of unpaid interest or fees. Keep statutory induplum as a hard backstop after default. Repo plus single-digit cap for unsecured credit. Single-digit annual cap for microloans under a low threshold. Ban initiation fees on microloans. No interest on fees in any product. Credit life insurance. Keep the 2017 premium caps but switch to opt-out. Require declining balance premiums by default, and impose automatic refunds where premiums exceeded lawful caps. B. Make debt review protective, not a trap. Consent rule with teeth. Debt review without consent is a criminal offense. All fees refunded. The counselor provider is struck off for a fixed term. Fast-track orders. Create a low-cost standard form court NCT order route for consensual restructurings. A 30-day decision standard. Automatic flag removal. On completion, or when indebtedness falls below a legislated ratio, the flag drops within 7 days via the NCR's registry. C. Lock in fair collections. No wage stripping. Write the Constitutional Court's EAO safeguards into statute with criminal sanctions for breaches. Cap total deductions from payroll for consumer credit at a humane ceiling across all creditors. D. Build the public community banking duplex. Postbank as the retail spine.
Mandated via shareholder compact to offer low-cost transactional banking, run targeted simple interest credit windows for students, smallholders, township enterprise, and provide payments resilience for grants, public services. Cooperative community banks as local lenders. Capitalize the CBDA, streamline licensing, and allow controlled wholesale deposits from state programs to be on-lent locally under simple interest rules.
Developmental wholesale partner, a narrow, treasury-owned wholesale arm that co-lends through co-ops Postbank, never displacing them and never offering compound interest to households. E. Supervision, data, and conflicts. Multi-year funding for the NCR to run proactive investigations, ring-fence an enforcement and forensics unit, implement a state-anchored credit registry for real-time supervision, revolving door rules, cooling off periods and conflict disclosures for senior roles across Treasury, SARB, NCR, FSCA, and major lenders consultancies. 4. Implementation roadmap. Phase 1, first 0-6 months, tax bills. Abolish estate duty and align CGT at death exemptions for primary residence, family business assets, expand zero-rated essentials, cut general fuel levy by a set amount, impose toll affordability test for renewals. Budget framework note. Publish the hierarchy of financing and the tax inflation alignment note, make the household impact annexure mandatory for any mass tax change. Credit Bill 1. Amend the NCA to outlaw compounding. Set repo plus single-digit cap for unsecured and single-digit annual for microloans. Ban interest on fees. Debt Review and Collections Bill. Criminalize non-consensual review. Fast-track standard orders. Codify EAO judicial safeguards. Postbank Compact. Table the shareholder compact with people-first mandates. CBDA appropriation. Allocate a multi-year capital envelope for co-op banks. Publish simplified licensing standards. Phase 2, Month 6-18, Resource Rent Bill. Enact the profit-based formula with floors and windfall tiers and publish sectoral effective tax rates.
Anti-avoidance package. Country-by-country reporting, presumptive profit rules in high-risk channels, expanded LBC staffing. Credit Bill 2. Establish the state-anchored credit registry, ring-fence NCR enforcement funding, legislate revolving door rules. SARB Treasury Protocol. Gazette the Coordination Protocol, table a joint statement on target path and distributional impacts. Wholesale partner. Established by notice as a narrow participation bank, publish participation rulebook. Phase 3. 36 months, independent 2-year review to Parliament on household tax burden shift, VAT share, debt service ratio, unsecured credit pricing, complaints enforcement outcomes, Postbank and co-op lending volumes, and use of balance sheet tools. 5. Oversight, metrics, and public reporting. Parliament should require a People's Balance Sheet dashboard, updated quarterly, with at least these indicators. Household tax share. VAT plus fuel plus municipal charges as share of household consumption. Debt service to revenue. Effective unsecured credit APR. Debt review outcomes. Average time to order, percent completed, refunds for misconduct, EAO issuance and breaches, tout and sanctions, public community credit share, Postbank plus co-op bank share of household and small enterprise lending, illicit flows recoveries, anti-avoidance adjustments.